Okay, so you're welcome, everyone. So today we are going to be looking at a new topic called property, plant, and equipment on IAS 16. And the intention is for us to finish it up today. Let's see if we would be able to achieve that. Let's see what we can achieve in this first period. Then in the next period, we would see if we are going to cover also a very good ground. So IAS 16 on property, plants, and equipment. So what do we have? What's our coverage here? What we want to look at in this standard, I'll start with definition of what PPE is. Then I will quickly move on to recognition of PPE. How do you recognize it? How do you record it in your books? When we have learned how to recognize it, then we'll learn something we call subsequent costs. Because after you have recognized, there would be some costs that would come up during the year. How do you also recognize that? Then also, we'll move on to measurement of PPE. And when we are done with measurement of PPE, then we'll move on to disposal of PPE. When we are done with that, we'll look at disclosure requirements for this standard. Then we'll look at questions. Let's see if we would be able to cover all of these in the 2 periods that we have. So the first thing is this. Let's have the definition of property, plant, and equipment, which we usually shorten as PPE. So I will write it in full now: property, plant, and equipment. Then going forward, I will simply write it as PPE. Now, what is it? So property, plant, and equipment is any tangible item that is held for use, by an entity, of course, by an entity in the production or supply of goods or services, rentals to others, and for administrative purposes. Of course, it must be held for more than 1 year. Now, it's expected that we all know this definition. It says PP is any tangible item. And everybody knows when we say something is tangible, it means something that you can physically touch. That's the tangibility there. So any tangible item that is held for use in the sense that you don't have the intention of selling it. You are holding it to use it. And use it for what? Number one, for production or supply of goods or services, rentals to others, and for administrative purposes. That therefore means that any item you have that is tangible as an organization that you hold to produce, that you owed to supply, that you owed to rent to others, or that you owed for administrative purposes, is most likely going to be a PPE, provided that you are holding it for more than 1 year, provided that your intention of holding it is more than 1 year. There are numerous examples, a lot. The popular ones we know, in terms of for production, we're talking about your heavy machinery or plants that you use in a factory, or your equipment. Or in terms of supply, you'll be talking about motor vehicle or delivery van that you use to supply, or any item that you are holding to rent to other people, or for administrative purposes, whether your furniture, your air condition that makes your activities in your office possible, your laptop, those are PPE, but they are only PPE if you are holding it for more than 1 year. That goes to show that if you are not holding it for up to a year or more than 1 year, it cannot be PPE. In that case, that means you're probably going to expense it. You cannot even capitalize that in the first place. That would not even be an asset in the first place, because PPE is an asset. Now, having seen this definition, it now depends on how well you can apply this in wherever, depending on the industry you belong. You see, those that are in telecom, for example, there are telecommunication cables, especially those fiber optic network providers. Those are telecommunication cables that they use to connect everybody. That cable is PP because they're using it to supply. If what you do, you are a shoemaker, for example, if you have a small machine that you use to produce those shoes, it's PPE because you're holding it for production. So think wide. Depending on the industry you are, will determine what's PPE to you. Now, having seen this definition, the second thing then becomes, how do we then recognize PPE? When I say recognition, as far as any standard is concerned, we are talking about recording of that item in our books. Before you can recognize PPE in our books, you need to meet two criteria. Two criteria must be met. And what are those two criteria for recognizing PPE in the books? Number one is that it must be probable. It must be probable that future economic benefits associated with this item will flow to the entity. So future economic benefits. It's clear that what we are talking about here is cash inflow or inflow of other benefits to the entity, either cash or non-cash, in as much as it's beneficial to the entity. So if it will flow to you, then good. So future benefit associated with the item is going to flow to you, then fine. This is what we call control, because this shows that you have control of the asset. So a core recognition criteria of PPE is control, but the standard didn't name it control. This is how it described it. But this description signifies control, because where the benefit of an item is flowing to you, it shows that's control according to the conceptual framework. That's control. And that's the first criteria that must be present before you can recognize PP in your books. Number two is that there must be a cost. There must be a cost. There must be a cost that can be measured that can be measured reliably. So the asset in question, the item in question must have a cost that you can measure reliably. So these are the two criteria that must be met before you can recognize an item of PPE in your books. Future economic benefits, the item must be able to generate that. The item must also have a cost. And having a cost, I'm sure you know that it does not necessarily mean that you have to acquire the item. They can gift it to you. Cost can simply be the price in the market, right? You would understand all those details as we progress in our study. Now, when an item meets this recognition criteria, then you can go ahead and recognize it in your books. So when an item meets the above recognition criteria, then the items, the item should be recognized in the books as follows. What do? You debit the asset, usually PPE, and you credit bank if you are buying the assets or other payables if you are buying the asset on credit. But who can tell me if we did not buy the item, if we were gifted, if somebody gave us the asset, who can tell me what we're going to credit? Can anybody try? If you did not buy the asset, you didn't pay for it in cash, you are not going to pay on credit, but they gifted you, what will you credit? Lekon, I can see your hand.
Donation.
Donation, you credit donation. So when you say donation, you really need to tell me, you're not the one donating the assets. If you credit donation, it looks as if you have donated it to someone, which you did not. So no, that's not the answer. Moses, I can see your hand.
Other income.
Thank you very much, Moses. That's correct. Other income. That's the correct answer. Is that it becomes an income to you. Because if you remember, in line with the conceptual framework, we defined an income as an increase in assets, decrease in liabilities. So when an asset increased and you did not pay for it, you were gifted, it becomes an asset. It meets the definition of an asset in line with this conceptual framework. Now, when you have acquired an asset and you have recognized it in your books using this approach I've just mentioned, there are still some costs that you would incur on that asset. Let me quickly address that. We call it subsequent costs. So these subsequent costs, these are costs that are incurred sequel or after acquisition of an asset. And these costs can either be expensed or capitalized and added as part of the costs of the PPE. So we can either capitalize, we can either expense it. You know that when I say expense, it means you are going to treat that subsequent cost as normal cost that you put in your P&L. You treat it as normal cost that you put in your P&L, like your normal expenses, like normal operating expenses. when I say capitalize, capitalization means that you would treat that cost as an asset and you are going to add it to the cost of that PPE. So how do you know whether you are going to expense an asset or you are going to capitalize it? So you capitalize a subsequent cost if it meets the recognition criteria. And what are the recognition criteria? Is the one we mentioned above. If it meets the two recognition criteria as mentioned above, which are the cost must be able to generate economic benefits, and you should be able to measure that cost reliably. And what does this mean? You see, in this context of subsequent costs, what does that mean? That you incur additional cost after you have acquired an asset. You now say that before you can capitalize it, it must be able to generate future economic benefits. It must have a cost that can be measured reliably. What does that mean? In this context, you see, of subsequent costs, so you see, these recognition criteria would mean the following. To mean the following. Number one, it will mean that the cost must improve the productive capacity and useful life of the asset. So when we say this cost must be able to generate future economic benefit, it means that the cost that you have incurred, this subsequent cost, must be able to improve the productive capacity of the assets, and it must also be able to improve the useful life of the asset. When we have a cost that can do that, then it has met those criteria, even if it is a subsequent cost. So examples of subsequent costs are, number one, you'll be talking about replacement of parts. So when you are replacing a part of an asset, that is a subsequent cost. Or when you are doing like a major repairs on an asset, major repairs, that would be that can also be a subsequent cost that are capitalized. Example of technical costs, let me write that are capitalized. So a lot of costs can fall into this, or probably you want to do like an improvement on the assets, whether you want to do a general painting of the assets. But the major example of subsequent costs that are expensed are majorly repairs and maintenance. So repairs and maintenance are usually expensed. And any costs that you classify in your books as repairs and maintenance, it clearly shows that these costs does not improve the useful life or productive capacity of the asset. This cost will only sustain and maintain the existing productive capacity, not improve it. You see, there's a difference between improving and maintaining or sustaining. If an asset or a car can go 10 miles or 10,000 miles all through its useful life, right? If you don't service it, it will not get to that 10,000 before the car will pack up or the asset will be rendered idle and redundant. But if you service it regularly, it will be able to do that. That's a cost that sustains. That's a cost that maintains. It's different from when you do a major improvement, a major repairs, a replacement of parts that will improve, that will increase the useful life from 10,000 to 15,000, from 10,000 to 12,000. That is not repairs and maintenance anymore. That becomes a major repairs. That becomes an improvement. Such costs are usually capitalized. You see, these are expensed because they only maintain or sustain the productive capacity of an asset. And that is it. That is subsequent costs. See, note that if it costs, okay, incurred. No, don't let me mention this now. It's too early. Okay, so that is the first part of our class today. Now, after subsequent costs, the next thing is measurement of PPE. Measurement of PPE. And when we talk about measurement, we are talking about getting the value that would be attached to this PPE. How much? So the approach to measurement, there are two. So the approach to measurement of PPE involves determining it at two levels. Involves, number one, you will determine initial measurements. And this is the measurement at the date of acquisition of the assets, including subsequent costs that I've mentioned above. That's initial, that's what we say initial measurements. These are the measurements you do at the date of acquisition of the assets, including subsequent costs. We also have subsequent measurements. We have subsequent measurements. And these subsequent measurements, this is the measurement at each reporting date. So for us accountants, we usually measure our assets not just when you bought the assets, but also at the end of each year. We usually measure and remeasure at the end of each year. That is called subsequent measurement. So let's discuss these two. The first one is initial measurement, which is the measurement at the date you acquired the asset. So an item of PPE is initially measured at costs. An item of PPE is initially measured at costs. That's how you measure an item of PP. It's as simple as that. When we say costs, then you need to ascertain what is the component of cost. You see, I can ask you, what's the definition of cost? Every one of you knows the definition of cost, which is the amount at which you bought the asset. That is cost. If you did not buy the asset, is the market price of that asset. That's the cost of that asset. So I think it's worth mentioning, really. So cost of an asset. Cost of an asset is the purchase consideration, or let me use this very simple language, is the amount the asset was acquired or fair value of consideration transferred or fair value of consideration transferred or the market price of the assets in the case where the assets was received as a gift. You should be talking about the market price of the asset in that case. There are instances where you did not, this is the amount the asset was acquired. So the amount you paid for the asset, there are instances where you did not pay money that it's possible to do exchange for assets. You can do exchange or part exchange. So the fair value of consideration transferred or fair value of the item transferred can be the cost of this PP, or if they gift you, is the market price of that item. That means you need to go to the marketplace to determine the market price. That can also qualify as the cost. Now, when we say costs, what is the component of the cost of an asset? What comprises the cost of an asset? Number one is the purchase price. The purchase price. But you know that purchase price, if you are importing the assets, purchase price will include import duty. So plus import duty and also if you are buying an asset, they will mostly add VAT, which is what we call it in Nigeria. So, but this is not a Nigerian standard, it's an international standard. Let me call it, in fact, the standard calls it non-refundable purchase taxes. This is similar to VAT. You also add that as part of the cost of that asset, plus non-refundable purchase taxes. And it has to be really non-refundable. If it's the one that you can claim as an input, like what the tax reform has done now, with the new tax reform in Nigeria, that allows you to now claim the VAT you pay on capital items. Now you can claim it as an input VAT. It means that the VAT now cannot be capitalized. You cannot add it as part of the cost of the asset in real life. But if it is non-refundable, in the sense that the tax you have paid is final, you cannot say you want to file your returns and say you want to claim that VAT back. Okay, then that's non-refundable. Then such are usually added as part of the cost of the asset. So plus non-refundable purchase taxes, less trade discounts and rebates. Okay, so this is very specific. It says trade discounts. You have to be very careful. they can give you another type of discount that is not trade. Such should not be deducted from the cost. So, example is this, let's say you bought an asset, you have a purchase price of an asset for 50,000. So you were given a discount. So you would give, so you will get a discount of 5% if payment is made. If payment is made within a month. You know that this is not a cash discount. So the discount above is not a trade discount. It is not a trade discount. It is rather a cash discount. It's a cash discount. This is not the discount we are saying you should deduct. This is a cash discount. And why can't we deduct this? We cannot, because this discount is not certain. It's not certain that you will get it. It's not certain you will get that deduction. This discount is conditional on paying within 1 month, which means that if you don't pay within 1 month, you will not get it. So that means that the costs of your assets will remain at 50,000 in your books. So if you eventually meet the condition for the discount, meaning that you paid within 1 month, you paid for these assets within 1 month. So meaning you met the condition for the discount. Then the discount should be treated as a discount received and recognized as an income in POL. So you treat it as a discount received and recognized as a discount received and recognized as an income in POL. So you see that 5%, this is just a discount received. You get 5% times 50,000. That's like 25. That's like 25. So you recognize it as an income in your P&L. So let's say you credit P&L, discount received, POL, 25. Hey, let me try you guys. What do you debit? Can any of you try? For this discount received, what will you debit?
That can I try? Trade payable.
Yes, please. You can go ahead.
So I said trade payables.
Thank you very much. Very intelligent girl. Trade payables. Trade payables. Thank you very much. Because all you have reduced is your liability. It has reduced your liability for you. So this is not the discount we are talking about. So the trade discount we are talking about, trade discount is a discount for bulk purchase. It's a discount for bulk purchase or being a first-time customer. a first-time customer to a supplier, that is a trade discount. A trade discount is not attached to any condition. So an example of such scenario is that you have a purchase price of an asset of 100,000. The guy decides to give you trade discount for bulk purchase. They will specify it's trade discount or discount for bulk purchase. At 10%. In this case now, we just deduct the trade discount, which is 10% times 100,000, which is 10,000. What you will get, what you will record as your purchase price in your books is not 100,000, but 90,000. And that's simply because you are getting this 10,000 outright. You are not even going to, this, in fact, this 90,000 that will be on your invoice. The guy would write it there. So that's why trade discounts, the only place you can find it is on the invoice. You will not find it in the books of accounts because it's 90,000 you just enter into your source in your books immediately. It's only on the invoice that the supplier gave you that you will know that at this point we were actually given a discount too. So you just enter the 90,000. But for cash discount, you will still see the 50,000 there. The 5% is just there is as a condition that we might give you and we might not. This one, you get it immediately. And that's the trade discount we want you to deduct from here. So we have purchase price plus import duties, purchase price plus import duties, plus non-refundable taxes, non-refundable purchase taxes, less trade discounts and rebates. And number two is directly attributable costs of bringing the assets to its location and condition, to its location and condition for it to be ready, to operate in the manner intended by management. So that's the second cost. That is a component of cost of PPE. Directly attributable costs of bringing the assets to its location and condition for it to be ready to operate in the manner intended by management. What do we mean by this cost? What are the examples of these directly attributable costs? So it includes initial delivery and handling costs, which is the cost of transporting the assets from where you bought it to where you want to use it. Or handling costs. If you have to package the assets, or on your way, you have to pay agbero or policeman that stopped you on the road just to get the assets ready, or just to get the asset to the location you want it to be. Initial delivery and handling. Okay, So the next one after initial delivery and handling is when you have dropped it, then you need to incur installation and assembly costs. When you take it to where you want to use it, you will need to install and assemble the assets. The cost you incur for that would also be a directly attributable cost. You might need to do some site preparation costs. If it's an asset where you have to do a base for, or an asset that you have to do a shelter for, or a land that you just acquired that you have to clear before you start building on it. Site preparation costs. These are also usually capitalized. They are directly attributable costs. If you need a professional lawyer or an architect to do something before the assets can be ready to operate, professional fees are also usually a directly attributable cost, whether architect fees or legal fees. Also, if you incur some employee benefits that are directly attributable to the acquisition of the assets. If you have employee benefits in the sense of your employees that you pay salaries, if they were directly involved in the process of buying the assets, then we would need to incur, you will need to add the costs as part of the cost of the assets. Finally, if you also have pre-production testing costs, so this is as it sounds. If you have an asset that you need to test before you can start operating it, the cost of testing you capitalize. And you see, cost of testing practically would mean probably maybe you need to buy some materials, you need to pay some labor. You see, all this money they will spend just to test the assets that is operating. That's pre-production testing cost. That kind of cost, you capitalize it, you add it as part of the cost of an asset, irrespective of what you bought, whether you bought engine oil, you bought whatever. The intention is you want to test this asset just to see that it operates. Now, when you now test it and it works and is able to produce some products, you're able to get some things from it. You see, that kind of thing you got from it, if you make money from selling that kind of item, you will not recognize that as income. You will come and deduct it from here. Less sales proceeds from sales of samples. So any sample you're able to sell from this testing phase, you will deduct the sales proceeds from the testing cost here. And I've given you 6. These 6 you need to know as reporting students. These are the directly attributable costs. And the manner in which we need to remember these directly attributable costs, they are the costs that if you don't incur them, the assets will not be ready to operate. They are what makes the asset ready to operate. If you don't assemble the asset, it will not operate. If you don't deliver it, it will not operate. If you don't get the site ready, it will not operate. And all of that, they are directly attributable costs. Now, it's important I mention at this stage examples of costs that are not directly attributable. It's important we mention that, okay, yes, these are the ones that are directly attributable, but there are some that looks like as if they are directly attributable, but the reality is that they are not. And a typical example that gets a lot of students confused is staff training. Students usually think staff training is directly attributable, but it is not. Because some people think if you don't train your staff to use this asset, now the cost you use to train them is part of the cost of the assets. That if you don't train them, the asset is not ready to operate. So it should be part of directly attributable costs. But the reality is this: the assets, as soon as it is ready, whether your staff know how to use it or not, that does not stop the asset from being ready. The asset is ready. So if you now have to incur cost of training people to use it, that does not deny the asset of its readiness. It's just your staff that didn't know how to use it. It's ready. So staff training is not a directly attributable cost. Another cost is the cost of opening a new facility or startup costs or other related pre-production costs, other related pre-production costs. These costs are expensed. You incur a cost to open the facility that you have incurred, that you have a structure ready, you then did an opening ceremony, you called people, or any cost that the asset is ready. You are not incurring some cost just before you start using it. You expense those ones. You don't capitalize them. Or the costs of introducing a new product to the market. Probably maybe you have produced, you are now incurring some costs to get the product to the market. And I mean, like advertisements and promotion, you don't capitalize those ones, you expense. Or you need to relocate some staff to the new facility. You now pay relocation cost for staff that will come and use the assets. That is also not capitalized. They are automatically expensed as they occur, or any other general and administrative costs. Also is initial operating losses. You started using the assets, you are incurring losses, they are all expensed. They are all expense. So it's important we mention this, and it's important you know it. It can earn you 3 marks in the exam in case I can decide to ask you. So that is number 2, directly attributable costs. Number 3 is the initial estimate of cost of dismantling, removal, and restoring the site to its initial condition. So if you have to incur a cost of dismantling, removal, and restoring the site on which you place the asset to its initial condition, you need to capitalize that right from the outset. So this cost is capitalized using the present value of the costs that will be incurred in the future. You know that this is not a cost you incur now. It's a cost you will incur in the future. That's why it's an initial estimate. Okay, and this usually operates in a situation where usually is required by the legal condition of the environment you operate, or you have made a commitment that after the period of the assets, you would help them recover their land and restore it. And this is common for those in the oil and gas industry, that they would bring in heavy machinery on the land to drill oil from the land, and there will be oil spillage and all that. So there are usually estimates of costs that they need to incur in the future. That cost should be added as part of the cost of the assets today. But because this initial estimate of cost is a cost you will incur in the future, so we do not recognize future costs in the books. We would recognize it at its present value. So we would get the present value of that future costs, and that is what we'll recognize as part of the cost of the asset today. And that's this point 3. And point 4 is borrowing costs, okay, that are directly attributable to the acquisition and construction of a qualifying asset. So qualifying asset is key here before you can capitalize a borrowing cost. So if the asset in question is a qualifying asset, which is an asset that takes a long time to get ready for its intended use, which is usually an asset that you construct yourself from ground up, that is a qualifying asset. If it's just an asset that you go to the market and buy ready, that all you need to do is just to incur some directly attributable costs to bring them ready, as you have mentioned above, then that is not a qualifying asset. A qualifying asset is an asset you construct yourself. So, and that's why we define it as saying a qualifying asset is an asset that takes a substantial period of time to get ready for its intended. So the standard did not mention the definition of substantial period, but we know that any asset that you construct yourself is a qualifying asset. So any asset that is self-constructed is a qualifying asset in this context. In this context, it is a qualifying asset. And when you have a qualifying asset, any borrowing cost, when we say borrowing cost, I mean interests that you pay on borrowing, interest paid. Okay, any interest you pay on borrowing on such an asset, that interest shall be capitalized as part of the cost of the assets. And that is the component of the cost of an asset. Okay. Ashaitan, go ahead with your question, please.
I wanted to ask that, like, if a company borrows money to buy an equipment as a whole, they did not build it or anything, wouldn't that still be classified as borrowing costs? It did not take them any time to make it.
So that is not a qualifying asset. So any interest you pay to acquire such an asset, you would expense it to P&L. You will not capitalize such interest. So the interest you capitalize as part of the cost of an asset is one in which you constructed the asset yourself. And the reality is that the interest is only capitalized to the date construction is complete. After construction is completed, if you are still paying interest on the cost you used to construct, that one will be expensed. That one will be expensed. Okay?
Thank you.
Yeah. You have been able to achieve this, and some part of this. So I just need to explain the remaining parts of this. Then probably in the next period, we would use that period to solve past questions and apply everything we have learned. And I hope you have been getting all our discussions from the definition. The major highlight here was the tangibility. What makes PPE is the fact that it's a tangible, any tangible item really can be PPE, provided that you're actually using it. And the usage here is production, supply, rentals, or for admin, and you are using it for more than 1 year, right? And yes, if it meets the definition, recognize it in your books. If it will generate future economic benefit and it's coming to you, to flow to you, meaning control, that's control. And it has a cost that can be measured reliably. So as soon as these criteria are met, this is how you put it in your books: debit, credit, either of these. Then after you have even acquired these assets, there are certain costs that will continually be incurred. We call that subsequent costs. So which can either be capitalized or expensed. Expensed means put it in P&L. Capitalized means add it to the cost of the PP. So before you can capitalize, those two recognition criteria I mentioned above must be met. When the context here, right, the recognition criteria would mean the following. Number one is that the costs must improve the productive capacity and also improve the useful life of the asset. And such costs that can do that are cost of replacement of parts, major repairs, or improvements on the assets. And the ones that cannot improve the productive capacity or useful life we call those ones repairs and maintenance, because they majorly maintain or sustain the productive capacity. Then how do you then get the value of an asset? It's either you're looking at initial or subsequent measurements. Initial is the measurement at the date of acquisition. Subsequent is the measurement at each reporting date. Initial measurement is at costs. Cost is the amount you pay to acquire an asset, or fair value of consideration transferred if you did not pay, or you might have given something else. What's the fair value of that thing? Even if you are given for free, what's the market price of the asset? That's the cost. There are four components of cost. One is purchase price plus import duty plus non-refundable purchase taxes, less trade discounts and rebate. And I explained these trade discounts well, because I don't want you to miss points on very trivial issues like trade discount. So you need to distinguish it from cash discount. There's also directly attributable costs, which are really costs that get the asset ready to operate in the manner you intended. Examples are these six that I feel you should know: initial delivery and handling, installation and assembly, site preparation, professional fees, employee benefits, pre-production testing costs, less sales proceeds from sales of samples. And these are examples of costs that are not directly attributable, like staff training, opening a new facility, introducing a new product, relocation, general and admin, initial operating losses. These are not directly attributable costs. Then there's the initial estimate of dismantling, removal, and restoring the site to initial condition. These are also capitalized at present value. You need to get the present value of the cost. Also, there's borrowing costs that are directly attributable to the acquisition and construction of a qualifying asset. And I made you understand that a qualifying asset is one that takes a substantial period to get ready. If it's an asset that you buy off the shelf that is ready at acquisition, that is not a qualifying asset. Any interest to pay on such borrowings would be expense, not capitalized. And I made a very important point that the capitalization of this borrowing cost is till when the asset is ready for it. It's till when the asset is, till when construction is completed. As soon as construction is completed, any interest to pay afterwards shall be expensed. Okay. Now, that being mentioned, we are now qualified to move to subsequent measurements. So for subsequent measurement, I mentioned earlier that we accountants, we usually measure assets at the end of every year. We continually remeasure. So in remeasuring the assets, so there are two ways. Okay. So those two ways, we call them models. So there are two models for subsequent measurements. In this case, call them models. So number one is cost model. And number two is evaluation model. So these two models helps you determine the cost of an asset or determine the value of an asset at the end of the year. And when we say cost model, this is simply the costs of the assets less accumulated depreciation less accumulated impairment losses. Okay, this is presented below. See, I'm presenting it below not because I need to, but I just really need you to see the fact that it is a model, it's just a formula. So if the exam, they can ask you in the exam that explain the models for subsequent measurement of an item of PPE. So nobody is expecting any special definition. Just tell us the model. Model is a formula. So again, like I've mentioned earlier, it's just the costs less accumulated depreciation, jackets, less accumulated depreciation, less accumulated impairment losses. So it's a model. So by the time you do this model, it gives you something we call carrying amount, which is commonly called book value, right? I really need you to call it carrying amount. I'm going to clean off this. So you can always call it carrying amount, or you can as well call it carrying value. Either one is okay for us now. So this is cost model. It's really not more than this. And you see, this means that at the end of the year, what you find in your asset account is more of this value. This is a carrying value. This is what you would see in the statement of financial position, right? But I really need you to understand this, that this model above is usually presented in the notes to the accounts, under what we call fixed asset schedule. It's important you know this, please and please. Most accountants don't know this, especially beginner, that we do this in a fixed asset schedule. They think we do it in the asset account. No, this is done in a fixed asset schedule in the notes to the account. So when you want to find your carrying amount, that is, you go to the notes. That's where you see the workings. And if fixed asset schedule does not represent asset account, do you know what you find in your asset accounts? The only thing you find in your asset account is the cost of the assets. Nothing beyond that. The only thing you see in the PPE account is the cost of the asset. You see this other accumulated depreciation, you would never find it in the asset account. There is an account, it too has its own account in your GL, in your general ledger, called accumulated depreciation accounts. And also the same thing, likewise, this one also, impairment loss account. It has its own account too, accumulated impairment loss. I hope you are listening to me and you're not distracted wherever you are. This is important. So when we are solving examples and I'm referring to assets and I talk about depreciation and you're telling me it should be taken to asset account, I'll be angry because I've mentioned it importantly and I need you to know it. That the only item you find in your asset account is the cost of that asset. Depreciation is found in accumulated depreciation account. Impairment loss is found in impairment loss. You see, this formula itself, these workings is done in a fixed asset schedule. And this is exactly how it's presented, as I've presented it to you. I'll still give you further details later. It's really not more than that. Second one is revaluation model. Similar to the asset account, the cost model, this is also simply, now we would have what we call a revalued amount less subsequent accumulated depreciation, less accumulated impairment losses. And this is presented below. Again, would have a valued amount, which can as well be called fair value. You deduct subsequent. So what is really different from this accumulated depreciation? This one is called subsequent, and it's just not just there as an adjective. No, it has what it means. It's to say subsequent accumulated depreciation. it has what it means, which of course I would explain in a jiffy, and also accumulated impairment losses. So altogether, they also give you the carrying amount or carrying value, or it could be the updated revalued amount as well in this case, but for consistency, let's call it carrying amount or carrying value. Again, this schedule, let me write it again just so you would, it sticks. This model above is presented in note accounts under fixed asset schedule. Let me even put it in red so you know that, yeah. So this one, revalued accounts, you find it in the asset accounts at costs. That's the component of cost we discussed above, like, yeah. This is the accumulated depreciation accounts. This accumulated impairment loss accounts. Accumulated impairment loss accounts here. So that is the model. Those are the models. That's how they really work, like that. So now, let me go back to the cost model first. Let me go back to the cost model. Now, this cost model here, you can see here the way it is computed. Now, I've already explained cost to you, which is the component of costs. And all we are doing with this cost is really at the initial measurement stage that we do debit asset, credit bank. And also at the subsequent costs stage. If there is any subsequent cost that we need to capitalize, they all come to these asset accounts. Then accumulated depreciation, we need to discuss it. Impairment losses, we will discuss it, but not in IAS 16, but in IAS 36. So there's another standard that deals with impairment losses. But IAS 16 actually deals with depreciation. So for the cost model, so from the component above, from the formula of the cost model, we have addressed the cost of an asset under the component of costs. So you already know that under the component of costs. And this cost is usually recognized in the asset accounts together with any subsequent costs, even with any subsequent costs, if you have any. So the next item is depreciation. How do we get that value? How do we get that value? So we need to deal with that. And I believe that every one of you knows what depreciation is. Okay? So let me just give you 1 or 2 minutes, or one of few people to talk about what they know about depreciation. Then I will then explain I will wrap it together and then we'll talk about it very quickly. So who wants to speak to depreciation here? Okay, so you can continue. So Fasha, you time with you.
Depreciation is the systematic allocation of costs over the useful life of the assets.
So, thank you very much, Fasha Iton. Fasha Iton said is the systematic allocation. Is there any other person? You can continue, Edward.
In addition to what I said, it is systematic allocation of depreciable amount of an asset over its useful life. And that depreciable amount is the cost less the residual value.
Sir, I don't know if you can also say it's a loss in value of an asset.
Yeah, sorry. Can you come again? I didn't hear you.
I said that I don't know if you can also say it's a loss in value of an asset.
Okay, loss in the value of an asset. All right. Okay. So we have systematic allocation, we have loss in value. Okay, let's have a word from you, Alabi.
Okay, sir. I don't know if you could also put it like this, like it's the reduction in the value of an asset due to the wear or tear of the asset over time.
A
Due to
reduction
its
in the
usage.
value of an asset due to wear or tear over time. Okay. Now, okay, I think I've had a lot of opinions. And the only one that is more like it is what Fashion has said. And the other ones are not depreciation. Okay. So it's important you also need to join the first guy and understand the fact that depreciation is not the loss in the value of an asset. Depreciation is not a reduction in the value of an asset. Depreciation is basically the systematic allocation of the costs. As it's just as Fashion has said it, that so depreciation is the systematic allocation of the costs or depreciable amounts of an asset over its estimated useful life. So depreciation is the systematic allocation of the cost or depreciable amount of an asset over its estimated useful life. So I mentioned that depreciation is not reduction in the value. I mentioned that depreciation is not loss in value. Why is that? And the reason is that we are accountants. We don't have the competence to measure reduction in the value of an asset. We don't have the competence to measure loss in the value. We don't have that kind of competence. That is not our work. Okay. And we cannot capture that. If we need to get the value of an asset today, we'll go and call a valuer or people that specialize in valuation. They will help us get the value of the assets. So please, you need to take that idea off your head entirely that depreciation is reduction or loss in the value, because a lot of assets that don't lose value, we still calculate depreciation on them, right? Why some also lose value, but depreciation is not a representation of loss in value, but rather a systematic allocation of the cost or depreciable amount of an asset. So the way depreciation works is that, you see, when an asset is acquired, and it's intended and is intended to be used for more than 1 year, let's say for 5 years, okay, these initial costs must be allocated over 5 years. Okay, so you see that cost you incur initially, that you go and put in PPE, that say you put in asset account. Yes, it's fine, right? But you need to spread that costs. You need to allocate that costs over the life of the assets, over 5 years. And this is in line with accrual concepts and matching concepts. This is in line with accrual concept and matching concept. So when we have accrual concept that says that you recognize costs based on the economic activity for the year. Matching concept that says that whenever you make income for a year, you need to match that income for that year with the costs that generated that income for that year. So when you incur a cost and the assets, when you incur a cost on an asset that you're supposed to use for 5 years, when you use the asset in the first year, you need to recognize a cost to P&L. And that cost for that 1 year of the asset is depreciation. So depreciation is simply like a portion of the cost of an asset that relates to that year. So each year you allocate a cost to each year. That, okay, because I've used this asset this year, this is the cost. Again, the asset is going to make money for you, right? It's going to make income that you're going to recognize in P&L every year. So when you recognize income to P&L, what will be the costs that generated that income? You cannot recognize the entire costs to P&L. That one is in asset account. So the portion that you match with that income for that year is depreciation. So depreciation is more like, okay, this asset that we bought and is useful for 5 years, this is its usefulness for this year. This is the cost we are attributing to its usefulness for this year. That's depreciation. And it's just complying with accrual and matching concept. And I need you to sing that, and I hope that is understood. To break this down further is, how are we able to achieve that systematic allocation? And again, I already mentioned costs, but I haven't mentioned depreciable amount, because that is what you are allocating really, cost or depreciable amount. Also, over its useful life, how is this also determined? So the easiest one is cost or depreciable amounts. So let me just leave cost out because we have already dealt with that, but we have not really touched depreciable amounts. And depreciable amounts, this is the cost less residual value. That is depreciable amount, cost less residual value. And residual value residual value is also known as scrap value, and it is the value of an asset at the end of its useful life. So residual value is also known as scrap value, and it is the value of an asset at the end of its useful life. So an asset might have a value at the end of its useful life. That value is known as residual value. And because it's the end of its useful life, whatever value that remains cannot be allocated to any further years, which is why we need to take that away from the cost right from day one. So the term we call the remaining amount is depreciable amount. I don't know why they decided to call it depreciable amount. They would have called it allocated or allocatable amount. That will have reduced the misconception instead of calling it depreciable amount, because if you look at the English word depreciate or emaciate, it looks as if something that that represents a reduction truly. But the intention here is not that. The intention here is to get an allocated amount every year. So the amount that is available to be allocated over the life of an asset is usually depreciable amount whenever there is a residual value, whenever there is a scrap value on an asset. And that is depreciable amount. And note that the residual value of the assets is an estimated value that is determined at the beginning of the life of the assets. So there's no way we can know this with precision, or we can have an exact amount. It is an estimated value. So don't be surprised if they tell you that maybe after 2 years there was a change in residual value. It can change. Any value that you estimate can always change, because you will have done your estimation based on the information available to you at the date of that estimate. When you have more information, you will definitely update that estimate. So residual value is an estimated value, and it's usually determined at the beginning of the life of the asset. So it's not, don't say because it's the value at the end of the life of the asset, so we wait till the end of its life. No, it's really determined right from day one. Now, I mean, you could be asking, then how do we determine that? How do we estimate that? I mean, it could be, if I want to be rational, I will say, okay, if you have a similar asset that is at the end of its useful life, we can use that. So a similar asset that's at the end of its useful life, you can get the value they were able to sell the assets, or the value attached to such an asset. Then that can represent our residual value. Really. Okay. That mentioned, there is also useful life. So this can be the period over which the assets is economically, the period over which the asset is economically productive, or the units that can be produced from an asset. So useful life can either be the period over which the asset is economically productive, and it can be the units that can be produced from an asset. So don't see useful life as just number of years. It can also be number of units. That's useful life. And again, it is also estimated at the inception of the assets. At the inception or at the beginning of the life of the asset, either one, at the inception of the asset. There is also an estimated value. So this one, again, how do you then determine what's the determinant of the useful life? Determinant of the useful life of an asset. What determines what the useful life of an asset can be? You see, you could have the useful life of a similar asset. Can determine how. Another one is the quality of the asset acquired will determine its useful life. It could be the limits, the limits that exists in a contract establishing the asset. So there are some assets that you have already agreed that you would use it for 5 years, or you will use it for 10 years, or whatever limits that exist in a contract that establish the other asset. Then that limit is the useful life. Or it could be the maintenance culture of the user. The maintenance culture of the entity can also represent the maintenance culture of the entity can also represent the useful life of the assets, can determine the useful life of an asset at the end of it, as it were. So, and there are other elements, other items that can determine how long an asset can live. So that's majorly useful life of an asset. And of course, this also can change. The same way residual value can change, useful life can also change along the period for whatever reason. Maybe after 2 or 3 years, you say, oh, the useful life has been extended by additional years. I mean, by the time you see that, this asset is still moving, is still okay, you can extend its useful life. Okay. And finally, systematic allocation. Systematic allocation. So from the name, systematic allocation, this is how you'd allocate the depreciable amounts. So there are really 2 ways, as mentioned in there are 2 ways, mentioned in the standard for systematic allocation. And number 1, the standard calls that straight line method. And number 2, the standard called that reducing balance method. So these are the 2 ways mentioned in the standard. So we're talking about systematic allocation. We said there are 2 ways in which we can allocate this cost. Is either we are using straight line method or you are using reducing balance method. You could see some other methods, but these are the 2 that the standard actually mentioned, and these are the 2 you would find in your exam. So when we say straight line method, so under this method, the allocation of the cost or depreciable amount is done equally over the life of the assets, or over the useful life of the assets. And that's why they call it straight line method. So we allocate the cost or depreciable amount equally over the life of the assets. But in fact, and let me write one more sentence to this. And this is done where the assets generate equal amount of economic benefits per annum. So the right method to use is straight line. Remember that all we're doing is accrual or matching. We're trying to match income or cost with income. Or we're trying to say that this is what we have used of this asset this year. Then let's allocate this cost of these assets to P&L. That's what depreciation is all about. Then if you are looking for how to do that, then it should be based on usage. So if an item or an asset generates equal amount of economic benefit every year, then you should allocate that cost equally. Okay? So it's flowing with the pattern of economic benefits. But reducing balance method, so for this one, so yeah, higher amount is allocated to the earlier years of the assets, while lower amount is allocated to the later years of the assets. And of course, you see that these really follow natural pattern of the life of an asset. At the earlier years of an asset, it makes more money. At its later years, it makes less money because it might not be as active as earlier years. So it makes sense that you are allocating much more costs to the earlier years as expense. Then it's later years where the asset cannot generate so much, then you're allocating lower. So it really flows naturally for most assets, right? So reducing balance is more practical. Then how is this determined? How is this calculated? So depreciation under straight line method is calculated as below. Every one of you can guess how to do this. It's simply the cost minus residual value, which gives you depreciable amount of cost, divided by the useful life. So if you do this, this will give you depreciation per annum to be equal every year if you use this formula. But under reducing balance method, depreciation is calculated as they will give you a depreciation rate. You multiply that by the carrying amount of the assets. And this method is also logical also, just so that the successive depreciation you calculate becomes smaller relative to the previous one. That's why they give you a rate, you apply that on carrying amount, and you know that your carrying amount is cost minus accumulated depreciation. So the carrying amount is an amount that reduces every year, with the amount of depreciation allocated every year. So applying a rate on a reduced value will give you, of course, a depreciation amount that is reduced every year. So this typically how depreciation is computed, and it's not difficult at all. So if you have an example where you are given a cost of an asset, you're given a cost of an asset as 100,000. You're given the residual value as 7,000, and you are given the useful life as 10 years. So you are now asked to calculate depreciation using straight line method. Okay. So let's say the depreciation per annum, and using straight line method, and determine the carrying amount of the assets. Let me put it that way. You know that to solve this, your depreciation amount using straight line method, or your depreciation, is cost minus residual value divided by the useful life of the assets. And the cost is 100,000. Depreciation is 7,000. Useful life of the asset is 10 years. The depreciation per annum simply gives me 9,300, right? With this 9,300, I'm asked to determine my carrying amount. My carrying amount, like I've mentioned, using cost model, is cost, which is 100,000, minus accumulated depreciation, which in this instance is 7,000. That makes my carrying amount to be what? To be 93, no.
No, sir, it's 9,300.
Yeah, thank you, Hashito. It's 9,300. This makes it 90,700. That's my carrying amount at year one. Now, since this is my depreciation per annum, that means every year I'll be calculating my depreciation is already calculated. What would then be my carrying amount at year two? The same thing. It's also cost, which is 100,000, minus accumulated depreciation now. My accumulated depreciation now is now depreciation of 2 years, which is 9,300 times 2. I guess that will be 18,600, right? So what will be my carrying amount in this case? What will be my carrying amount in this case? That would be 79,400. That would be 79,400. Remember, with this solution, I can do the same thing for year 3, year 4, year 5, year 6, up to year 10. Now, you see, this determination of carrying amount that I'm doing, all of this is done in my notes to the account. All of this
Excuse
is
me, sir.
done in a fixed asset schedule. Inena,
Yeah, sorry to butt in, but the cost subtracting 18,600 from 100,000 is 81,400.
thank you, Nina. 81,400. Thank you.
400.
Okay, thank you. Okay. So, as I was saying, you see, these workings that I'm doing, I really need you to understand that in real life, you need to understand that this is done in a fixed assets schedule in the notes to the account, right? And usually, you see, this depreciation amount, it goes to your P&L every year. It goes to P&L. So what goes to P&L every year is 9,300. You see, this amount is what goes to the statement of financial position. Okay, and you reference the workings you have done. But as you can see, in each year, the cost of the asset remains the same, meaning your asset account remain at 100,000. It does not change. It's at 100. This one that I'm reducing is in a separate account entirely. And if you need to know the journal entry for depreciation, this depreciation will compute per annum. From these workings we have done, who can tell me the journal entry for depreciation? What's the two legs to it? Who can tell us? Okay, Moses.
Yeah, every year you debit your P&L and credit your account dip.
Thank you very much, Moses. That's absolutely correct. So you debit P&L, which is this depreciation that we computed that goes to P&L every year, and the corresponding credit goes to accumulated depreciation, which is this. That is why in year 2, accumulated depreciation has doubled, because in year 2, you will have credited accumulated depreciation again. So it's cumulative. Accumulated depreciation is cumulative. It's increasing every year because you're crediting it every year. And that's what you take to your fixed asset schedule at the end of the day. So a lot of people would have said you credit assets. And I'm happy Moses did not say that. He said you credit accumulated depreciation. So if you have said credit assets, then I'll say no, you don't credit depreciation to assets. I've told you what goes to assets is just the cost. Depreciation does not go to assets and all of that. So thankfully, it did not repeat that mistake. So this is how you'd usually recognize depreciation. So if you have another example where you were given the cost of an asset as 250,000, you were given residual value of the assets as 20,000, and we are given a depreciation rate as 20%. We're now asked to calculate depreciation and carrying amount of the assets and carrying amount using straight line method, and reducing balance method. So if you are told to do this, that you should calculate depreciation and carrying amount using straight line method and reducing balance method with this scenario given. So in this case now, using straight line method, my depreciation per annum, is my costs minus residual value divided by the useful life of the asset. My cost in this instance is 250,000. My residual value is 20,000. Now, in this case, I was not given my useful life. But what do? Costs minus residual value already gives me my depreciable amount, which in this case is 230,000. You just multiply it by the depreciation rates. Okay, so your depreciation, if this is the depreciable amount, your depreciation per annum is just the depreciation rate, which I'm given as 20%, multiplied by my depreciable amount. In this case, I have 46,000. And that is my depreciation per annum. Every year is 46,000. Same amount. Straight line method, you have to get the same amount of depreciation every year. So which means that if you are not given a depreciation rate, if you are not given a useful life, you can use depreciation rates. All you need is just to get the depreciable amount. Then the rate will represent the years, and that gives us 46,000. In this case, my carrying amount at the end of year one is simply the cost, which is 250,000 minus accumulated depreciation, which is 46,000, gives me my carrying amount of 204,000. Then in year two, I can easily determine my carrying amount again for year two, which is the cost, which is 250,000 minus accumulated depreciation, which is now 46,000 per annum times 2. And that will give me what? That's 92,000. Confirm if I'm correct. Then, when I do my 92,000, if I take that away from 250,000, I should be looking at 158,000. Confirm if I'm correct with those figures that I'm bringing out. So, and I can continue. It's like that. Now, again, remember that what goes to P&L is this depreciation per annum of 46,000. What shows in my statement of financial position in each year under non-current asset as PP is this 204,000 in year one and 158,000 in year two as my carrying amount. It's because of the fact that carrying amount reduces. That's why people think, oh, depreciation is the reduction in the value of the asset. No. The cost is still the cost. What you find in asset account is costs. It's costs. This is just carrying amount. This is just is just really actually telling us that this is where we are as at today. This is the position as it is relating to every activities around the assets in terms of the cost and its allocation, that we have allocated some portion of it. So the meaning of carrying amounts really means the unallocated portion. the portion that we have not allocated. That was why when I was teaching you deferred tax, that was the same way I interpreted carrying amount to you, which is the depreciation, the tax the company wants to charge over the remaining life of the assets. And tax base is the deduction the taxman wants to give you. That's why when the tax base is higher than carrying amount, you have a deductible temporary difference, which is what carrying amount actually represents. Carrying amount does not represent the value of an asset. No, it is not, because it's really not the value of the asset. It's really the unallocated portion of that asset. If you want to get value of an asset, you get a valuer. You get a valuer, or you probably be using a revaluation model that we are going to get to very soon. So now, if you are using reducing balance, and I'm just stopping in here too, just because I want to stop. I'm just using this to teach you principles. So if you are using reducing balance method, the depreciation per annum, like I've mentioned to you earlier on, is just depreciation multiplied by carrying amount. And in year one, my depreciation is simply the depreciation rate. This is supposed to be depreciation rate. Depreciation rate times carrying amount. So year one, I'm just starting. So the carrying amount is equivalent to the costs. So my depreciation in year one is simply 50,000 from here. It's 50,000. And this 50,000 is just year one depreciation. So in year one, my carrying amount under this model, under this method, is costs, which is 250,000, minus accumulated depreciation, which is 50,000. So my carrying amount at the end of year one is simply 200,000. In year two, my depreciation rate times the carrying amount now, which is 200,000. So, and that gives me 40,000. You see my depreciation has reduced, reducing balance. My carrying amount in year two, is my cost, which is 250,000, minus accumulated depreciation, which is 50,000 in year one, plus 40,000 in year two. And that is 90,000. So if I do 250,000 minus 90,000, I get my carrying amount as 160,000 or 170,000, 60. That's 250, 990. 160,000, and I can go on and on. You can see the difference in the methods. These apply the rate straight on the depreciable amount, and it doesn't change every year. These apply the rates on the reduced amount, on the carrying amount, and the depreciation reduces every year. Note that if you are not given a depreciation rate, you cannot use the reducing balance method. So don't even complicate it at all. That's the simple principle. If you are not given depreciation rates, you cannot use the reducing balance method. You can only use reducing balance method when you have a depreciation rate. Now, Another example under this, if you have the cost of an asset as 300,000 and you have accumulated depreciation, as 90,000 and you have useful life. Let me use depreciation rate, is more flexible. If given depreciation rates of 10%, okay, I'm now asked to calculate depreciation using straight line method and reducing balance method. Now, for this, using straight line method, my depreciation approach per annum still remains the same. It's simply the depreciation rates times the cost. Since we don't have residual value in this case, that means my depreciation per annum is simply 30,000. But using reducing balance method, I already told you that depreciation per annum is depreciation rates times carrying amounts. And what's my depreciation rate in this case? I know it as 10%. So 10%, so 10%, what's my carrying amount? Is cost minus accumulated depreciation, which is 300,000 minus 90,000, and I have 21,000. And final example is if you have costs of an asset as 210,000 and you are given the useful life as 5,000 units, and we're told that in year one, this asset can go for 2,000 units, can do 2,000. In year two, we're told this asset can do 1,500 units. In year three, I told this asset can do just 1,000 units. And in year four, this asset can do the remaining 500 units. So 2,000, 3,555. So in this case, we're given the depreciation in units. And you are asked to calculate the depreciation. In this case, the resulting depreciation is not reducing balance, neither is it straight line. The resulting depreciation method of allocation is based on the pattern of usage, which is just the idea. So I'm giving you this example to make you understand that depreciation is really calculated based on how you use the asset. That should determine how much you allocate at cost. If you can easily know this pattern, this is the best. If you can know that, oh, the total unit this asset can generate is 5,000, and you can foresee how many units you can do each year, then fine, good to go. Then you should be able to use that to allocate your depreciation. So how do you do this? Your depreciation will be in year one, since it can do 2,000 out of a total of 5,000 in year one. Just multiply it by the costs. If you were given residual value, you multiply it by cost minus residual value. Whatever you get is your depreciation in year 1. In year 2, you will just do 1,500 divided by the total life of these assets, which is 5,000, multiplied by 210,000. That gives you year 2 depreciation. Year 3, you do 1,000 divided by 5,000, multiplied by 210. It gives you year 3 depreciation. And in year 4, you do 500 divided by 5,000, multiplied by 210. That gives you year 4 depreciation. And this is how depreciation works. And this is how depreciation is calculated for cost model. Even for evaluation model, it doesn't really change. It's still the same like that. So I think you guys have really tried. This is already 5 o'clock. You have done 2.5 hours with me already. Let me allow you. Let's continue in our next period. So in the next period, I'm still in subsequent measurements. I've done a lot around depreciation, right? In the next period, I would teach you about this evaluation. That's what we're going to do in the next period. So yeah, I will share these notes with you now, just so that you can revise it before the next period. Thank you guys. Enjoy your short break. See you. Bye.